There are many reasons why you should not buy a house. There are many ifs and buts as to when you should buy a house. But equally important is why you should have real estate in your investment portfolio. Whether one should buy real estate and have real estate in the portfolio of investment or not is an old age debate world over. It is as much a topic of discussion within the built environment of real estate as with financial world, personal finance. Arguments on both sides of the divide have their own merit, but the fact remains that there is no one size fits all answer. The personal finance professionals believe that stock market and mutual funds rewards are far greater in the range of 14 to 18% per annum. The real estate proponents, on the other hand, assert that real estate rewards no less over a longer period of time, and it also saves the investors from the cyclic market volatility. I am Ravi Sinha and I believe ROI, return on investment, that is no doubt the primary criteria in the investment basket of an average Indian. It is never the only parameter to evaluate the asset class worthiness. Let's take a few case studies that would clarify how different asset classes are meant for different sets of investors and different mindset. Say for first case study is somebody's father bought a piece of land and built up a house in 25 lakh rupees some 25 years back. Today the cost of the house is 3 crore. That sounds like a mouth-watering return in absolute terms. However, in terms of actual returns, with or without inflation adjusted, the returns are not what other asset classes like gold, stock, or mutual funds would have given. The compounded annual growth rate of the said property is just 10.45%. In the given period, gold returns are 12.05% CAGR. Mutual funds that have completed 25 years in India have given a return in the range of 14 to 23% CAGR. Now, let's look at the case study 2. Somebody who has already got a house since 2020 post-COVID. The person has also built a rewarding stock portfolio of say 50 lakh rupees with a CAGR return of 22%. Now that one has to invest even more, the natural urge is to go for higher returns with a stock market only. However, the person opted for a commercial property that promises to offer around 12% returns. And reasons are very simple: risk diversification, and to be in a position where one can liquidate any of the investment as and when needed. As we all know, investments baskets are cyclic. Investment products are cyclic. If one asset class goes down, the other asset class goes up. Now, these two case studies are in contrast, but it might give an impression that stock market and mutual funds are the best bet for an average Indian. What it does not tell you is that every investor's risk appetite is different. Regions for investment are different, and one does not want to put all eggs in one basket. If we look at it historically, the risk averse Indians have an affinity for property. The new age investors are more risk takers and they go for high risk and high return asset classes. But then they too are prone to risk mitigation through mix and match of investment. As is evident with the case study 2, it's always a matter of perspective. Market returns more often than not outpace real estate, but real estate provides tangible assets that can generate steady rental income and offer a hedge against inflation. Secondly, real estate investments allow for leverage, where using borrowed capital can amplify returns on equity investments. Also, the tax breaks available for purchasing property, interest, principal payment while investing in a tangible asset bring additional value for the purchaser. In times of economic turbulence, real estate acts as a safe haven. It preserves capital and provides reliable returns when other investments go down. Therefore, while diversification and risk mitigation are significant benefits, real estate's inherent strength make it a valuable component of any investment strategy. When we look at VIX, volatility index, the VIX might drive away from capital markets, as in India is one of the countries where people tend to save money in bank accounts rather than investing them in a return for that generate profits. Financial knowledge on where to invest would be beneficial if we plan to invest our money somewhere. Gold versus real estate is a common confusion among the people who think of investing. Each of them has varying degree of volatility and risk return potential. Hence, before zeroing in on asset class to invest in, it is vital to understand the pros and cons of equity versus gold versus real estate, of course. Investment is not a risk-free process, and hence, it is better to have a good understanding about risks and asset classes. Every investor should choose the right asset class to invest depending on their own appetite for risk. Asset classes can be broadly classified into three: real estate, gold, and equities. Equity can be stocks and mutual funds. Gold can be physical or jewelry, and real estate can be equated as a property. What are the advantages with real estate? It's a tangible asset. It can never lose its intrinsic value. It's a hedge against inflation. It's a risk mitigation product. There are tax advantages, and it's less volatile. What are the disadvantages of real estate? Bigger ticket size. You can't go and buy a property with 2 lakhs or 5 lakh rupees. Lower returns than equity market. It's an illiquid asset class. You can't sell it as an when you want immediately. There are holding and maintenance issues, and transaction cost is also very high. So these are the advantages and disadvantages with real estate. But diversification is a critical strategy for risk management. Even the high risk takers agree that real estate investments balance a portfolio heavily weighted in equities and provide stability during stock market volatility. Moreover, real estate has intrinsic value and utility, a fundamental need for housing and business operations, which often maintains its demand even during economic downturn. While diversification is essential, property investments offer several standalone advantages. It also offers tax benefits such as deductions for mortgage interest and depreciation. There is no one size fits all answer, and each asset class attracts a different set of investors, each having their own distinct exposure, mindset, risk appetite, time horizon, and amount of capital to invest. For those investors with an overall exposure of various asset classes, real estate stands as an asset class of risk mitigation. So, while in this series we have discussed so many disadvantages of buying a house, a property, there are certain benefits too that any investor should keep that in mind. Thanks for watching.